I think the visual search engine thing is pretty interesting, and I think the story is text is sort of in decline, and people want to take their information and their interactions in picture and video form. And so to that extent, I think Pinterest is actually pretty well positioned to possibly be a content platform more broadly than it has been. And that's what I think is the most exciting, sort of as yet not fully developed feature that the Pinners, the community it's called, Pinners, has going forward.
Zoom video we would focus on as well. This is a company that's very profitable and growing at 100%. These are the companies that I think might do well for investors and have less risk since they're earning money.
Let's get more on the story now from Santosh Rao in New York. He's head of research at Manhattan Venture Partners. Welcome back to the program, Santosh. Let's start with Zoom. There was a lot of interest in this video conferencing firm. It's one of the few unicorns to have actually turned an annual profit. But at one point, its stock soared 80% above its IPO price. Why was there so much demand?
Yeah, thanks for having me. What you're essentially seeing today with Pinterest and with Zoom is that investors are looking for growth stocks. They need growth, they're hungry for growth stocks. And these two, and if they have a path to profitability, or if they are profitable already, that's even better. And that's what you saw with Zoom. Clear winner there, revenues growing at a 100% clip plus, 100% plus, and already profitable. So it's a good company in a good space and doing very well in terms of metrics. And Pinterest has a path to profitability, revenues growing 60% and profits maybe by next year. So I think that both those things combined, unlike Lyft, where there's a path to profitability, is still kind of dicey or uncertain. Here you had a clear path. So I think that's the winner today, growth and profitability.
Yes, there was a lot of nervousness around these two IPOs in the wake of Lyft's debut last month. In that case, there was a lot of excitement. The share price jumped on opening, but shares are now down around 17%, and that's just a couple of weeks after they listed. What went wrong with Lyft then?
No, I think Lyft is a long-term story. So and that's the mistake people are making. They're making too much out of this decline. Yes, the bankers did not do a good job. They priced it way above what they should have. And it wasn't managed well. The aftermarket was, after the pricing was not managed well. Too many people sold short and all that stuff. So there was a technical problem with the IPO process itself. But overall, I think, and also there was Uber behind it. So there was this overhead that, the big one is coming behind it. So there was some limit to how far it could go. But overall, I think Lyft in the 60 to 65 range is a reasonable price. I mean, though it's slightly below, but it's around that number. It's growing. The future is still unknown. So I think that's the thing about ride-sharing company. It's going to be transformational. It's going to take a while. It's a long-term 3 or 4 year story, not a 1 year story. So we need to be patient. And they both have different models, even though they're in the same business.
I read some interesting...
Uber and Lyft, that is.
Yes, I read some interesting analysis that pointed out that we haven't seen this rate of tech companies listing since the dot-com boom/bust of the late 90s, early 2000s. Do you think we're seeing a similar pattern here? Are we in danger of entering some sort of a bubble with these massive valuations for companies that haven't even turned a profit?
No, absolutely not. I mean, there is no bubble. Unlike in the past, in the 90s, like you mentioned, those companies were much younger. These are 8, 9, sometimes 10-year-old companies. The revenue models are well developed. The whole business model is much better developed, even though profitability is still a ways out. But I think in terms of getting the traction and establishing the market, they are much more mature and much more, the investors have a better insight into what these companies are capable of doing. So I would not compare it to that. These are transformational companies that are coming to market, and the bad ones are getting punished, like the Snaps of the world, and the good ones will be rewarded. So I think that's what you're seeing. There's a big difference between the two.
All eyes now are on Uber's IPO. Obviously, some are expecting it to debut next month. What can we expect from that, just very quickly?
Yeah, I think what they've done is learn from the Lyft experience. They don't want to get ahead of themselves. So there is the impression, the optics that they have pulled back on the valuation, though I always believed that Uber was valued at closer to 85 to 90 billion. That was always our valuation. I mean, we follow these companies way before they become household names. So we are pretty precise. We thought 120 was very unreasonable in the first place. But that aside, so I think at 100 billion, I think they can make a case, the bankers can make a case that we are a diversified company, we are into everything. Ride-hailing is still in the early stages of a long cycle, and so they can position themselves there. The issue is going to be profitability. Both of them have to prove that. Both of them have to be a show-me story. That's what they're going to be. So we'll see what the first quarter earnings come out at, see the trends, the patterns. Even though these are storied stocks, 2 or 3 years down is when we'll really get a feel for what these companies are capable of doing.
Okay, we'll see when they finally make their debut. Santosh Rao in New York, thank you for your time.